And I think it's really a function of supply and demand side factors. Demand has been impacted significantly by elevated mortgage rates, of course, as we all know. And then supply, you're seeing a buildup of unsold spec inventory. Builders are having a hard time selling some of their homes in those markets.
And that's what the experts want you to believe, that the issue facing the housing market is a function of supply and demand and has nothing to do with the real economy. But the reason builders are sitting on such a large inventory, in fact, the largest since 2009, had everything to do with the fact that they were bullish on housing and they thought prices were going to rise, and they wanted to build as many homes they could now and sell them at even higher prices down the road. But as far as consumers, again, the experts say it's everything to do with interest rates and that prices are just too high. And if the Fed would cut rates, it would increase affordability, and then consumers would come out and buy in droves. But again, the real issue facing the economy, what we're facing in the housing market as well, is now the worst since 2009. And this just isn't a U.S. issue. As we look all around the world, we see that housing markets are facing a bubble scenario, one that could send prices crashing. And tonight's show is brought to you by Monetary Metals. If you're interested in earning a yield in gold, paid in gold, check out the links in the description and pinned comment below. Because as we dig into the housing market, what we're finding out has everything to do with economic fundamentals. And the risk here is if housing continues to slow down, well, what it means is the economy could face an all-out recession, if not a financial crisis. As new home construction falls to a 5-year low, and this is dangerous because, again, right now the biggest problem with the economy is a slowing labor market, and as construction falls in new housing, what it means is there's less demand for labor. It's going to put people on the unemployment line, and as their spending goes down, well, the housing market is going to go with it. The issue there is, as builders start cutting their production back, what it means is they're going to be forced to cut prices. As they cut prices, well, watch out. We're facing a massive correction all across the board. Housing starts decreased 9.8% to an annualized rate of 1.26 million homes last month. The report illustrates a subdued home construction activity as builders face a number of headwinds, including inventories of completed houses that now stand at the highest level since 2009. But this is the same issue that's facing the other parts of the economy. We've noted that manufacturers have been front-running the tariffs. We've seen this at the wholesale and the retail level, that everybody's been building up inventory because they want prices at today's level. They want to sell them in the future at higher prices. This is exactly what the builders did. They believe if you build it, people will come. But the problem is the real economy has been slowing. And based on some of the latest data we have as of last week, it appears to be getting even worse. And builder sentiment right now stands at the lowest level since 2022 as firms contend with an uneven demand and face the risk of higher costs for imported materials as a result of the Trump administration's tariffs. At the same time, the share of home builders lowering prices in June rose to 37%. This is the highest the National Association of Home Builders data has going back to 2022. And one of the issues we've said that will plague the resale market is a lot of homeowners do not have the ability to cut their prices if they need to sell. However, builders do. And as they cut prices, it could put downward pressure on prices all across the nation. Again, the risk is you face the fact that if prices go down, that people do not want to buy homes in a falling market. We're seeing this happen in China and other parts of the world. And again, it's all setting up for a massive correction in prices. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com Stephen. The risk to any investment. Risks of leasing gold include but are not limited to loss of gold principal from leasing to monetary metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through monetary metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. Sales of new single-family homes decreased a whopping 13.7% to 623,000 annualized last month. That's now a 7-month low. And that was below, of course, all estimates, because what happened is everybody thought the housing market was going to boom and take off. But what happened is consumers found out that the economy is not working in their favor, that their paychecks relative to inflation are shrinking. And at the onset of a weakening housing market, they don't want to buy. But the bigger issue is they can't afford today's prices. So as you start to see builders cut back on how many new homes they're building, watch out. That means prices are about to plunge. And the evidence is clear as we look at this chart of all transaction house prices, that's shown in blue on a year-over-year rate of change against new privately owned housing starts, that in red. And you can see the very clear relationship. As builders increase the number of houses they're building, prices go right along with it. But when they start to cut, prices come plunging down. And that's the risk we're facing right now. Builders are sitting on the largest inventory since 2009. You're seeing housing starts continue to decline, likely to break down even more. And as that goes, you're going to see more than just 37% of builders cutting prices. At some point, you're likely to see 100% of builders doing that. And there's a major risk here because, again, we look back at the labor market. Approximately 8 million jobs are tied to the new construction of a house. This is a major issue because, again, as builders cut back, it's going to affect a lot of people's income. They're going to be forced to cut back, particularly if they have a job. If they lose their job, it's going to be even worse, and that's going to backfeed all across the economy. And you can see the issue here isn't about supply or demand. The issue is about the labor market and incomes. Let's take a look at average weekly hours of production and non-supervisory employees. That's shown in blue, overlaid against new privately owned housing starts, still shown in red. And you can see the very clear relationship. It's not about rate cuts. It's about paychecks. And when paychecks are rising, people want to buy homes. When their paychecks are shrinking, you can see that housing starts go down. The issue we're facing right now, as we look back to that non-farm payroll report on Friday, on the headline, the print was really good, but there were some major structural issues with it. The reason the unemployment rate went down is because people were leaving the workforce, and that's not what you want to see. In fact, the headline print was largely due to the education sector. You strip that out, you find out that the economy continues to decelerate. But remember, we talked about under the hood. What were the issues? Wage growth, only 0.2 month over month, and now down to 3.7% year over year. That's a major issue. But the bigger one, it's weekly hours, and they declined in a major way. And I said, look, if these continue to go down, and many people said, look, it's going to head higher now. It was all due to the tariffs. If you see this continue to fall, housing starts are going to go down. And the next thing you know, it's going to pull the entire economy with it. And it starts to make sense. Again, we talk about that non-farm payroll report. What was one of the biggest issues in it? The people that had been on unemployment for an extended period of time were finding themselves with little or no opportunity to get off unemployment. It's all a sign of the economy. Again, it's not about supply and demand, because if the economy was booming, consumers could afford higher rates. And if the economy was indeed booming, well, builders wouldn't be sitting on a massive amount of inventory. The real issue, again, comes back to the economy. And let's take a look at what else came out last week. And this was something that the media completely brushed aside. They were focused on the non-farm payroll report, but the real story now is in the services sector. And why does this matter so much? Because when we talk about services, what have we heard over the past few years? That the slump in manufacturing didn't really matter. Everybody had bought everything they needed during the pandemic. Now they're going to focus on services, and as services boomed, it was going to pull manufacturing up. We said, look, the exact opposite is going to happen here, and the evidence is clear. There's a reason the media overlooked this, because the ISM Services PMI came out in 50.8. Now, above 50 shows an expansion, but the problem here is for the services sector, anything under 53 shows that it's slowing down or plateauing. And this is a risk here because if the services sector goes, it's just an indication of what I've been saying, is that as consumers have less money, they spend less on the discretionary side of the economy, and next thing you know, the whole thing falls apart. But let's look at some of the respondents are saying, because they're talking a lot about tariffs and rising prices. We're seeing some restaurant traffic remaining flat. As I go out, when I do, I notice that traffic at restaurants is down, and that's a major issue. A lot of managers there are saying that there's a problem as consumers are not eating out. But it's not just a rise in prices that we're seeing a lot of businesses complain about. You're seeing capital investments are being severely curtailed. Business growth is slow, and sales are down. And this, again, is a major problem spreading across the economy, because as business slows down, the need for employees goes with it, and that impacts the housing market. So you talk about rate cuts. This is what the experts want you to think. Hey, if the Fed would just cut rates, demand would come back. But the bottom line is, if people are getting less hours at work, if they're not getting the pay raises they want, and they see business slowing down, they're not going to take the risk of going out and buying a new home, particularly at today's prices. But when builders are forced to cut, remember the last time they did this, we had a financial crisis. You can see it setting up again. Let's dig into that ISM Services report, because we see quite a few red flags. We see new orders. Now, that is in expansion at 51.3. Again, remember, anything over 50 denotes an expansion. So on the onset, this is good, because if new orders are up, it means the demand for labor is up. But I said, there's not enough new orders to sustain the workforce. Sure enough, what do we see right in the employment data? 47.2. So what we're seeing from the ISM is that the services sector is laying off. So again, you go back to that non-farm payroll report, you strip out the education jobs, and what do you find out? The U.S. economy is indeed slowing down here. This is a major issue. Prices up in a big way, 67.5. That is a massive increase, following last month's 68.7. So what that tells you is service providers are seeing huge increases in prices. But what's impacting the employment sector? It is the backlogs. And now you see a contraction at 42.4. It's contracting at a faster rate, meaning that the services sector has too many employees. They don't have enough new orders. And again, this is exactly what we warned would happen. When the backlog started to run out, that you would see employers start to cut jobs. It's happening now. We know they're cutting hours, and all that does is backfeed into the housing market. So you think about builders have too much inventory, they're not going to be able to clear it. And rate cuts aren't going to make a difference. But even though the housing market's going down, I still want you to make money in the market, and my Momentum Timer Pro subscribers are, and you could have gotten this trade for free. That's right, we have a free 30-day trial if you grab that link in the description below. And this is a blockchain fund. Now, we told our subscribers back on June 27th, you see I forgot to update it there. They're now up 12.32%. And again, this could be you. All you have to do is grab those links in the description below, use a coupon code for your free 30-day trial, and start jumping in on these trades. Now, while the ISM said things were getting bleaker, particularly for the employment sector, S&P Global gave us a slightly different picture. They noted that growth sustained in June, but to a softer degree as tariff uncertainties linger, although the rate of growth lost some momentum compared to May. And that's not what you want to see in the economy right now, because everyone's been talking about how the economy's been building momentum. And we said, no, it's building momentum in the wrong direction. Now we're seeing validation from S&P Global that said it remained well below levels recorded in the second half of 2024. Now, why is that important? Because we were going into the election, and everybody thought the economy was going to boom if we got the president everybody said we needed to have. And so what we did is, in the economy, it started to accelerate. And then what happened is we got in the first of the year, it started to decelerate as economic fundamentals started to come back in play. So then what fell into place? Well, people were front-running tariffs. We said that wouldn't change the needle, and now we're seeing hard evidence it's not. And if we're going to come back to the housing market, it's all about the labor market. Let's take a look at that non-farm payroll report, again shown in blue on a year-over-year rate of change, still overlaid against new privately owned housing starts in red. You can see the very clear relationship. As housing starts go down, it affects the labor market. And again, 8 million Americans are tied to the new construction industry alone. And you can see here, as weekly hours go down, that means housing starts go down, and that means the non-farm payroll report goes with it. So while you saw a lot of people on Wall Street Street and investors get super excited that the labor market was holding up. Everything we see here in the U.S. tells us it's getting worse. But as I started the show, it's not just about us. It's happening all over the world. Let's turn to China as China's new home sales slump persists as calls grow for more stimulus. The value of new home sales from the 100 largest property companies stood at 339 billion yuan, which represents a 23% fall from a year ago. And June sales followed an 8.6% decline in May. On a monthly basis, however, the latest sales were up 14.7% from May. Of course, if you have to make it look pretty, you got to look at the month-to-month data. What it's saying is China's real estate market is decelerating as well, and they pumped a massive amount of stimulus to prop it up. And what have we said? The issue with China is it's all about demand, because when the global economy weakens, then consumers there see it, they cut back their spending, and the big problem with their housing market isn't the fact that they're not selling. The issue is the fact that the lenders, the banks, put a lot of money into these builders. If the government forced them to, if the housing market there continues to crash, it's going to margin call the banks, could blow up into an all-out financial crisis. And all this means is more support will be needed, but what have we noted about stimulus is it doesn't work, and what you're seeing in China, it had a very brief effect, and it's still not working. Now we can look to Country Garden. You remember they actually had some issues going into default with their loans, and what are you seeing? Sales slid again in June, with the developer faring far worse than its peers. As you see, sales dropped 35% from a year ago. Again, this is a major problem because a lot of these developers have massive amounts of loans on them, and they need to pay them. To pay them, they've got to sell homes. Can't sell them, next thing you know, money runs up. You wonder why when you hear about dollar shortages or money shortages despite central banks cutting rates. It's because the economy slows, not enough money's created, and it gets eaten away in debt payments. It creates a massive vortex in the financial system, one that pulls everybody down. And Country Garden has been counting on a turnaround in sales, but good luck with that. We said it wasn't going to happen because it was looking to restructure its debt after a default from more than a year ago, suggesting that what you're going to see from developers, not just in China, not just in the U.S., but all over the world, is rising number of delinquencies and defaults as sales go down. And that means that they're going to be forced to do is cut prices aggressively. Again, we go back to 2009. That's exactly what we saw, and it drove the housing market right into a financial crisis. But again, as we look to our neighbors to the north, Toronto home prices fall for a 7th month as the economy slows. Again, it's about the economy, not about the Fed, not about inventory. Those just make it worse. The benchmark price of a home in the country's largest city slipped 0.9% in June. And again, you talk about why people don't want to buy. They don't want to buy in a falling market. Same thing with the equity markets. When stock prices go down, people don't want to buy. But when it's going up, people want to chase it higher and higher. Same thing's true with the housing market. And all this is going to do is lead to an unwind in the economy and the labor market. Now let's take a look at new privately owned housing unit starts, still shown in red, overlaid against continued claims, that shown in blue. So you can see on a weekly basis, it's not just going to affect the headline non-farm payroll report, it's going to affect unemployment claims as well. And you can see those 8 million people tied to the housing market, well, as they lose their job and their spending goes down, it reverberates all through the U.S. economy. You can see cycle after cycle. When housing starts to go down, the labor market unwinds. And what we can see right now is hours drop, housing starts to go down. It means the continued claims are likely to go higher. And for that non-farm payroll report that everyone was excited about could be the last of the good reports. And we could see that means that prices are likely to go down as well. As now we're going to overlay continued claims against all transaction house prices in red. And you can see as consumers lose their job and can't afford a house, well, prices must come down. Same thing's going to happen in the broad economy. We're going to see all that inventory overhang lead to disinflation, perhaps even deflation in some cases. And so what we're seeing is very clear signs here that a massive correction in housing prices is in the cards. How big it is, how deep it's going to go, we don't know. It's all going to depend on economic fundamentals. But if we go into a financial crisis, look for prices to have a massive correction. But even if the economy goes down, doesn't mean your trading account has to go with it. Let's take a look at that trade we put on BKCH. We told our subscribers to buy here right on the open after it closed above its 200-day moving average. That's shown in orange. Prices have surged higher there. We said technically this was a great trade, and sure enough, it played out. Now, how do we do this? Each and every day we run a screen on on momentum, and we call that our Momentum Timer Pro report. We look at those technical indicators like the RSI and the MACD, and we aggregate them together to really find out when something's coming out of oversold territory or when momentum is rising. But when we pair it with a rising price trend, well, what you do is you get some amazing trades. Those show up right on our hot list each and every day. And plus, on top of that, you get all the momentum signals across the broad equity, bond, currency, and commodity markets on a 1 day, 1 month, 3 month, and 6 month window to help you with your trading. Now, you get the dealer report, you get all the signals, but here's the best part. You don't even have to read the report because I break down all the trades and tell you which ones I think are the best. We give you full risk control levels and update them along the way. We give you tracking of all of our open trades in return and a weekly update. Of course, on top of that, you get the 30-day free trial. And why do we do that? Because we're so confident that you can make money trading our momentum signals that we want your first 30 days to be on me. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.